So, again, good afternoon, everyone, and welcome. My name is Jessica Hollenstein. I'm actually very proud to serve as the vice chair of LIBOR's commercial committee, and I'm so glad that you're with us here today. Um, as some of you may know, October is commercial month here at LIBOR, and it's our chance to spotlight the resources, education, and opportunities that help our commercial members thrive. So, throughout the month, the commercial network is hosting events, webinars, such as the one today, and networking sessions to strengthen your business and highlight the impact of commercial real estate across Long Island. So, today we're focusing on one of the most powerful tools for investors, 1031 exchanges. We are so fortunate to have Ryan Vassar here, Assistant Vice President and Account Executive with IPX 1031, the nation's largest qualified intermediary. IPX 1031 has been helping real estate professionals and investors navigate the complexities of tax deferred exchanges for over 30 years. Ryan brings a wealth of knowledge and practical strategies to share with you today. We're really happy you're here. Last but not least, if you'd like to learn more about our commercial network or get involved, we're going to kind of be posting some links in the webinar chat. But you can always visit lirealtor.com/commercial. Very, very simple. So thank you again for joining us. Let's get started by welcoming and saying hi to Ryan Vassar.
Thank you for that introduction, Jess, and thank you to Evan as well for helping set this up. Very excited with the turnout today. Looking forward to your questions and looking forward for the chance to present to you all. I'm looking at the names that I see here, and I see a couple of familiar names. So good to see all of you again, and nice to meet you if we haven't yet. But hopefully we can work together in the future. Without further ado, I'm going to pull up the presentation that I prepared. So just to sort of preface this presentation, I do a handful of these different presentations for brokers, attorneys, CPAs, financial advisors, and each one's a little bit different. This one's a little bit more geared towards real estate agents, and brokers. But there are going to be a number of topics that I sort of brush on here. If anybody has any further questions about some of the more complex issues, because this does go up to 3 hours, the longer versions of this presentation. This one's just going to be a 1 hour. But if anybody has any questions, this is my phone number. This is my email. I cover the state of New York, so I'm based out of Long Island. I want to be a resource for everybody here. So feel free to call. There's no charge to you or your client. If they have questions, I'm happy to give advice. And then just keep me in mind whenever a 1031 opportunity comes up. All right, so just to start, for anybody who may not have heard of what a 1031 exchange is, or maybe has only heard about it in passing, this is the actual language of Section 1031 of the IRS code. It essentially says that if you are selling investment property, so long as you're buying investment property, then there won't be any taxable liability on your capital gain. The reason I like to highlight this word real in the tax code is because in 2018, with the Tax Cuts and Jobs Act, they actually eliminated the ability to 1031 with personal property. So you used to be able to 1031 fleets of rental cars, fleets of rental jets, any personal property that was used for investment. A colleague of mine actually did an exchange with a violin from the Boston, Massachusetts Symphony. So I thought that was interesting. Unfortunately, I was not doing 1031 exchanges at that time, but I do like to bring that up, just a bit of history there. And the other thing I always highlight on this slide is that 1031 defers taxes. It is not a tax-free transaction. Eventually, if you do come to a point where you choose to sell property, you've been 1031ing for a long time, but now you're selling property and you're not doing an exchange, those taxes are going to be due at that time. So people will call me and say they want to do a tax-free exchange. There's really no such thing as a tax-free exchange. There are ways using 1031 that you can minimize taxes. And down the road, upon your passing, that's really the only way to completely eliminate taxes. Death and taxes, the two certainties in life. Moving on here, one of the first questions that I always ask potential exchangers when they call me is what's your basis in the property? So just a quick basic accounting for anybody who maybe doesn't know what your basis is or how to get it. Your basis is the combination of three numbers. It's your original purchase price of the property, plus any non-expensed improvements that have made over the lifetime of the property, and any depreciation taken during your ownership of the property. So just as a simple example, you purchased the property for $300,000. You made $50,000 in improvements, and you've taken $100,000 in depreciation. Your adjusted basis is $250,000. Now, when you go to sell that property, you're selling for 650,000, your gain is 400,000. So fairly simple and using easy numbers here, but it does sort of always help me to get an idea of what your basis is. That's really in order to see if A, a 1031 exchange is worth it, and B, exactly how much money you should be looking to reinvest in order to get the most out of your 1031 exchange, which we'll sort of dive into a little bit deeper later on. Another big area often comes as a surprise to exchangers when they call me. I start to talk to them about 1031. I start going over what the mechanisms are, what you need to be wary of, misconceptions that are out there, and it sort of starts to sound complicated. My job is to always try and take on those complications so you don't have to worry about them. But I do understand that, especially when you're dealing with large transactions, especially when it might be somebody who only has one or two investment properties, this is one of the biggest transactions they're making in their life. It starts to get a little bit overwhelming, and they say, well, you know what? I only make $100,000 a year. I'll just pay the 15% capital gains tax and I'll just pass on the exchange. It's not that big of a deal. Well, especially in a state like New York, unfortunately, that is not the case. If you don't do any sort of 1031, you're looking at multiple layers of taxation. You do have your federal capital gains tax at either 15 or 20%, depending on your income, and depending on how you're filing. And then also one thing that should be noted there is the IRS is going to include your capital gain from that transaction during that year. So while it may be true, maybe you only make $200,000 a year or $150,000 a year from your normal day-to-day job, your sale of this property could very well bump you up into that higher income bracket. So on top of the federal gains tax, you have the 3.8% healthcare tax. The reason it's called the healthcare tax is it was originally placed under Obamacare in 2008. It's still in under the Tax Cuts and Jobs Act. Sometimes it's called the net investment income tax. And it's a 3.8% tax on any amount over 200,000 if you're single, 250,000 if you're married. Depreciation recapture, very common for individuals owning investment property to take advantage of depreciation while they own the property. You get tax benefits as you go, and you can deduct from your income tax if you take depreciation on the property. But when it comes time that you're selling that property, the IRS wants to recapture some of the depreciation that you've taken over the years. The depreciation recapture tax is 25%. And then you have state taxes, which obviously in places like Florida and Texas are nothing, if, not a big deal. But in New York, we are the proud owners of the second highest income tax or the second highest state tax in the country. So just behind California, we have a 10.9% tax on capital gains. So after you take all of those numbers together, in New York, you're looking at anywhere between 33 and 35% of your gain that's going to the federal and state governments. So it's not just the 15%, it's not just 20%. In New York, you're looking at closer to 33%, 35%. Just to go through a quick example of what that looks like in New York. If you're selling a property, just to make things very simple, you're selling a property for $1 million. You have no mortgage on the property, so it's entirely paid off, and you've fully depreciated the property. So your basis at this point is zero. That means if you sell the property, you have a gain of $1 million. The entire property is gain. And this actually happens more than you may think. People who have owned property for, tens of 20 years and now they're getting around to selling it, or maybe it's been in the family for a long time and now they're getting around to selling it and they're looking at this giant capital gain, which is great, but then they find out what tax bill they're going to have due. So in this situation, you have $1 million sale. Your capital gains tax in New York is anywhere from 330 to $350,000 that you owe. Now you're left with $650,000 and you can reinvest that in stocks, you can reinvest it in real property, whatever you want to do with that $650,000, but you lost 350 in the process of the transaction. On the contrary, or on the other side of things, if you choose to do a 1031 exchange, you have $1 million of gain in the property. You pay zero in capital gains tax, and now you have $1 million that you can reinvest into real property. So just as an example that I like to use in this case, you had $1 million property. Now you're going to buy another investment property. You can buy a $5 million property with a 20% down payment and a $4 million loan. And now you can slowly build and build and build upon this real estate empire. And you can continue to reinvest and continue to 1031 over your lifetime. You can see how these tax savings can generate a larger real estate portfolio over the years. Now, beyond just that, there are a handful of reasons why a 1031 is beneficial. So obviously the tax benefit is the biggest, but there are ancillary reasons as well to why a 1031 would be beneficial to any taxpayer. The first one being cash flow. Maybe you bought a plot of land and you were planning on building on it and investing or renting that property out or using it as investment property of some kind. You had the intent to use it as investment, but it's not generating any income right now. So you sell that raw land, you have a large capital gain or even any capital gain, and you reinvest that money into property that's already improved. And now you have a cash flowing property. Again, we come back to depreciation. You may have fully depreciated a property. In the example that we just used, you had $1 million property, but your basis in it was zero. If you do end up going into that $5 million property, now you have $4 million more in depreciation that you can take, which you can recognize benefits immediately, especially now that bonus depreciation has made its way back. But just depreciation alone, in reinvesting in a higher value property, you can see benefits right away. Your income taxes will be lower. You can take deductions there. On the other side, appreciation. We saw a lot of this during COVID. I still see a lot of this now. Not just appreciation, but also some governmental reasons as well. People getting out of New York, going to more landlord-friendly states. But disposing of property in a slower market area, or maybe it's just a more high cost of living area for the landlord, and acquiring property in an area that's a little bit more friendly to landlords, or offering investments that you'd rather be involved in, or better investments with a higher return on investment. So that's another big reason for an exchange as well. Conversion. This is a lesser known area of 1031 that we're going to get into a little bit deeper later on in the slideshow. But essentially what you can do is you can sell your investment property. You can use 1031 as a tool to purchase your dream home or a vacation home. It has to start as investment property, but you can convert it down the road into property that's just for personal use. So that's a great sort of exit strategy and retirement plan for anybody who's invested in real estate and looking to move or looking for a vacation home. You can use 1031 to do so. Another reason for 1031, and this one becomes extraordinarily complex, and it is what I spend a lot of my day doing, and that is the joint ownership problems that I run into on a daily basis. Whether it's a partnership that's no longer working out, or it's a partnership where one is looking to get out of real estate, the other one wants to stay in real estate. 1031 can offer a handful of different solutions to get out of that partnership, go your separate ways, and each partner can go into whatever investments or whatever area they want to go into. It does take extra planning. There are extra considerations to take into account, but it is definitely possible. It is very common, and sometimes people don't realize that it's going to create an issue until they call me or somebody like me. But it's definitely something that requires planning, expertise, your CPA, your attorney, and if you ever run into that situation, just give me a call and we can discuss it a little bit further. Um, Another area, another big motivation for 1031, and I saw, I think Declan's on the call here today, so hello, Declan. This will specifically interest him. But reduction of management burdens. There are a handful of different alternative investments. I like to call them armchair investments out there that offer a heavily invested real estate individual to get out of real estate, but still do it tax free. Again, we're going to get into it a little bit more later on, more of the specifics, but things such as Delaware statutory trusts, triple net leases, mineral rights. There are a handful of deals out there that an investor can sell a property that they're actively managing every single day, dealing with tenants, trash, toilet. And there are investments out there that they can go into through 1031 that allow them to be completely hands off and still see a gain on their investments, but they're not having to manage the property every day and they're not having to deal with the headaches of being a landlord. Another area which is very popular is estate planning. So this is sometimes used in conjunction with those alternative investments because it allows the person to retire and still be invested tax-free and pass property or one of these alternative investments to their heirs. One of the interesting things about any real estate, not just 1031, but when an individual dies and their property is passed on to their heirs, those heirs are going to receive what's called the stepped up basis. So the heirs are going to or inherit the property at the value of the date of the passing. So if let's use that $1 million example before, so zero basis, $1 million sale. If that individual sells, he's looking at 335,000 in taxes without an exchange. If he passes though, and it passes on to his heirs, then they're going to inherit that property at the $1 million valuation, and their basis will be $1 million. So if they were to sell the property, they're not going to recognize any taxes because they're selling it for the value of the property in which they inherited it. So using that in conjunction with some of those alternative investments, or just using it as a way to maybe diversify your investments in preparation for your passing, you want to set your kids up. 1031 can definitely be a way to do that. And you'll see the example here. If you own one property, it's very difficult to divide one property between three children. If you own one property and you 1031 into three different properties, you can leave one to each child. If you go into those alternative investments, you sort of have shares in a property which you can divvy out amongst each of the heirs. So there are a lot of different ways that 1031 can come into part or into play with an estate plan. We also see the use in a profession. So a doctor or a lawyer, plumber, engineer, whoever it may be, has a rental home. They choose to sell that home and they acquire a building to support their business, whether it's a medical building for a doctor or an office building for a lawyer. They now own the real estate that they're working out of, and they can also rent out other offices in that building to generate additional income, which is actually a more popular approach than you may think. So why this is all relevant to you guys, and why I do enjoy talking to brokers is because you guys are the first ones that are involved in a transaction. A lot of the times the accountants are not even aware that something's being sold until tax time comes around. the attorneys, which I am an attorney as well, so I don't want to badmouth all attorneys, but they don't always know what kind of property is. They don't always know what exactly is going on. As the real estate broker, you guys are the first one speaking to the clients. You have the more in-depth conversations, and you're involved throughout the entire process, not just one stage. So you guys have a better look at to what's going on, what the situation is, what they're thinking of doing with the profits or the proceeds on the other side of the sale, and why investor clients tend to be better for brokers, in my opinion. They're less emotional. They're looking at bottom lines. They're not looking at, the emotion that's tied to a property or seeing themselves living in the property. They're strictly just concerned with how much money can I make off of this property if I were to buy it. For 1031 clients in particular, you have motivated buyers. We're going to talk about it in a little bit, but there are timelines associated with 1031, and there's not a lot of forgiveness with those timelines. So exchangers have to sort of get moving and they have to get out there and look for properties and buy properties. And 1031 sort of helps to keep the market going, even when it slows down, because people have to be doing deals. They have to be replacing property. And it sort of helps to keep the real estate market moving. And the biggest thing is that it can lead to multiple transactions. If you are the one who introduces them to 1031, shows them that they can save, especially in a situation where you're saving them $300,000 in capital gains tax, you're now handling their listing and you're also handling their purchase on the replacement property. So you took one deal and you turned it into two deals, doubling the commissions as well. So why right now is a good time to talk about this, as I'm sure everybody saw recently, and sort of the forecast is it for it to continue, is that interest rates came down. So they dropped 25 basis points, and most people are expecting to see another at least 25 to 50 points by the end of the year, with perhaps another drop at the beginning of 2026. So this is just going to sort of jumpstart the market a little bit, especially for investors who maybe want to get out of a property, but they're hesitant to because they have a lower rate mortgage right now. They don't really love the property. They don't want to, they're not seeing the best returns, but they're paying a low interest rate. So now as rates continue to drop, we're going to hopefully see more and more investors moving property around, going to different areas, and it should sort of jumpstart the market a little bit. And as I briefly discussed before, bonus depreciation was recently reenacted, which basically just allows an investor who owns property to take depreciation right when they purchase the property and see a tax benefit right away. So with the bonus depreciation and the interest rates, we're hoping to see more and more deals going through. So how can I be of service to all of you is exactly how I said before. I do these classes, whether it's on these larger scales. I also do smaller seminars. I go to real estate offices and to law offices and accountant firms, and talk to, 10, 15 people at a time. A little bit more personal. I can answer questions directly. But like I said, you can always call me, you can always email me, and I am happy to discuss 1031. It's already what I'm doing all day, so another call I would be happy to. So, what is like-kind property? A lot of people call me and they are not sure what they can buy. They sold a triplex and they're wondering, do I have to buy another triplex? Do I have to buy residential? What can I buy? So in the United States, all real property is like-kind property as long as it's used for investment purposes or for productive use in trade or business. So it doesn't matter the nature of the property or the characteristics of the property. You can exchange raw land for a commercial building, a residential building for a retail building, single family for multifamily. Like I discussed before, you could sell industrial property and you could buy DSTs or a triple net lease or one of those alternative investments. So the like kind requirement of 1031 is extraordinarily broad. It's not so much about what the property actually is, it's what you're using the property for. So long as it's for investment purposes, then it is eligible for 1031. There are a handful of things that are specifically addressed in the tax code that say this is not like-kind property. And the reason they do this is because some of these things look like-kind property, but they're not. One of which is partnership interests. So that being said, a partnership, let's say me and Jessica are a partnership and we own a property. Me and Jessica, the partnership, can do an exchange. However, I can't sell my 50% interest in the partnership and buy real property on the other side. The partnership owns the real estate. My interest in the partnership is not exchangeable. Only the partnership's interest in the real property. So that is part of the reason why, as I mentioned before, it requires some planning. If there is a partnership involved that wants to go their separate ways, um, then call me. But another expressly not like-kind property for Section 1031, stocks, bonds, and notes. This comes into play when there is seller financing involved more than anything. So that if the seller is holding the note in the 1031 exchange, they haven't received all of the funds. They're not actually holding funds. They're holding a note for the property. So that creates a whole nother layer that we need to deal with. And it can be done with seller financing, but again, it requires some additional planning. Another one, primary residence and vacation homes. Primary residence is fairly obvious, but I still get calls about people who are looking to do a 1031 with their primary. For anybody who's not aware, there is the 200, Section 121 gives $250,000 and $500,000, depending on single or married. Deductions for capital gains when you're selling your primary residence, but there are situations where people are seeing capital gains much larger than that. And they call me and they try to do a 1031, and I have to explain that they can't do it with their primary residence. Vacation homes happens even more often. Your vacation home is not eligible for 1031. It has to be investment property. Securities and evidence of indebtedness. Again, this brings us back to that seller financing a little bit. And certificate of trust or beneficial interests, similar to partnership interests. If you are the beneficiary of a trust, so upon so-and-so's passing, you're going to inherit this property, you can't 1031 with that beneficial interest. And then a big one, which I get all the time and a lot of people don't realize, but stock and trade or other property held primarily for sale. This is basically directly addressing flippers and developers. So if you're flipping property or if you're building, developing homes, new homes, the IRS looks at that as inventory. They don't look at it as an investment property. So 1031 requires you to hold the property out for investment, not just fixing and flipping. So fix and flippers, developers, not eligible for 1031. So a couple of the basics of things to think about, the conversations I have when I first get on the phone with somebody who says, I don't know much about it. What do I need to know? What do I need to look out for? One of the big ones that I run into is the same taxpayer requirement. There are a couple of exceptions, but for the most part, whatever taxpayer is selling the property has to be the same taxpayer that's buying the property. So individual Ryan Vassar sells a property, Ryan Vassar has to buy a property. Partnership sells, partnership buys. Corporation sells, corporation buys. There are situations where there is a disregarded entity involved, meaning a sole member LLC, for example, owns the property. A sole member LLC uses the sole member's social security number to file taxes. So that gives you a little bit of flexibility. For example, you have ABC LLC owns the property you're selling, but it's a sole member LLC using your social security number to file taxes. So the taxpayer is actually the individual, not the LLC. So what you could do is you could then buy with another sole member LLC, so you distinguish between the two, and therefore it helps for liability reasons. So there are some ways to sort of get around the same taxpayer requirement. But again, if you have questions, call me. But overall, whichever entity is selling has to be the same entity that is purchasing. Actual and constructive receipt. So this is one of the big no-nos in Section 1031, and it's a call that I unfortunately get too often, and it's the reason why I do these seminars is the exchanger cannot have actual or constructive receipt of the funds when they sell their investment property in order to qualify for Section 1031. Actual receipt is the person who calls me and says, "Hey, Ryan, I just closed on my property. I want to do a 1031 exchange. I'm holding the check in my hands right now." And I have to tell them, "Unfortunately, you're holding the check in your hands right now. You've already received the funds. There's nothing that we could do. You're not eligible for a 1031 anymore." Constructive receipt. An agent of the exchanger, meaning their broker, their title agent, their attorney, their CPA, anybody who the exchanger has control over, they cannot receive the funds either. That is constructive receipt. The idea of it being if your attorney's holding the funds, you can tell your attorney, put the money here, give me the money, do whatever. So anybody who is an agent of the exchanger can also not receive the funds. And that is the role that the qualified intermediary and IPX 1031 play, is that we hold the funds during the time of the exchange to avoid any sort of actual or constructive receipt issues. We're a completely neutral party. I always tell people I am an attorney, but I am not their attorney. I am here to offer guidance. I cannot offer legal advice. Our main role is we are setting up a segregated account for the funds to come into at the time of the sale in order to hold the funds until the exchanger is ready to purchase replacement property. So the basic timelines, which are a very common topic as well. What is day zero in an exchange? That is the day that you close on the property, the transfers of benefits and burdens of ownership. So the reason why I brought up constructive receipt before is that you want to contact a qualified intermediary prior to closing on the property. The best time is after you've gone under contract, before you've actually closed. So you have day zero on the day that you close. And from there, you have two clocks that start ticking. You have your 45-day identification period and you have your 180-day exchange period. That's 180 calendar days. That's 45 calendar days. So weekends, holidays, doesn't matter. There are no exceptions. 45 days is 45 days. And as you can see, they both run concurrently. So you don't get 45 and then 180. You get 45 and 180 combined together. So within that 45 days, the exchanger must identify property to be purchased. And within 180 days, the exchanger must actually close on one of those properties that they've identified. The only exception out there is federally declared disaster exemptions. So if you are located in a place like Florida, you're going to see a lot of these. If you are somewhere like New York, you're not going to see very many of these, and you shouldn't hope for one because there's absolutely no guarantee that you're going to get one. The first federal disaster exemption was actually in New York. It was not weather related, it was during 9/11. But since then, it's predominantly been weather related events, which is why you see them so often in Florida. But for the most part, don't count on it. You want to make sure that you identify within 45 business or calendar days and 180 calendar days to actually purchase the property. So, there are a couple of different ways that you can make your identification. And you have really the first two are the most common, with the three property rule being by far the most common of the three. The three property rule allows the exchanger to identify up to three properties regardless of the fair market value of those properties. That's the most common for somebody, particularly who's selling one property, buying one property. They identify the property they really want. Maybe they identify one or two backups and they go through the exchange and that's it. Another one, which sort of brings us back to that estate planning example that I mentioned earlier, where you have an exchanger who's selling one large property and going into three smaller properties, the 200% rule. So people will say, well, can I identify more than three properties? And I say yes. But if you identify three or more, or sorry, four or more properties, then the total fair market of those properties cannot exceed 200% of the relinquished. So if you sold for $1 million, you could identify four properties that are $500,000 because collectively they're $2 million. So you didn't exceed 200%. This is more common for somebody who's selling one property and going into multiple smaller properties. Finally, we have the 95% exception. This is extremely rare. Really, I only see my big real estate investment trust clients and large institutional clients using this rule. It's basically where they have failed at the three property rule and the 200% rule. And now, in order to save the exchange, they have to purchase 95% of all of the value of all the property they've identified. So, as I'm sure you guys can all put together in real estate, if you've identified $100 million worth of property, you might not be able to just buy $95 million worth of, yeah, $95 million worth of property because maybe it was 10 properties all worth $10 million. So you have to purchase all of them. This is really only used, like I said, with the real estate investment trusts. They've done all of their due diligence prior to starting the exchange. They know what they're buying. They've done all the environmental reports. You don't usually see your everyday exchanger utilizing the 95% exception. So the first two are really the most important to be aware of. Now getting into what exactly do you need to spend in order to make a 1031 worth it? What should you know going into the exchange? So this is really the four rules, of a full tax deferral. You follow these four rules and you won't pay a dime in taxes. First, you want to buy property of equal or greater value. So you sell for $1 million, you buy for $1 million. Second, you reinvest all of the net proceeds that you received when you sold the relinquished property. So your sales price minus any debt that you paid off, minus your closing costs, reinvest all of those net proceeds. Three, you want to replace the value of the debt. So you sell $1 million property and at closing you pay off a $200,000 loan. You now need to, in order to have a fully deferred exchange, you now need to reinvest the 800,000 or so into the property. Plus, you need to replace that $200,000 loan. So if you had a $200,000 loan prior, you want to get a new mortgage for $200,000 on the replacement property. The IRS essentially wants the exchanger to be in the same position that they were before with just a change of address. So whatever debt you have, you're going to want to replace, and you can replace it with new debt, which is the most common. Other times, what happens is it's a higher net worth individual who says, you know what, I don't want to get a mortgage. I'll just replace my debt with cash. So you sold for $1 million, you had a $200,000 loan, you bought for $1 million in all cash, you still have a fully deferred exchange. And rule number four, receive nothing in the exchange except for like-kind property. So non-like-kind property, we refer to as boot. And the two most common are going to be cash and debt relief, which I'll give you a couple of examples of in just a moment. But as I said, boot is any non-like-kind property that's received in an exchange, cash, installment note, debt relief, or personal property. So any of those things are received, and you're going to incur some sort of tax on the value of what was received. That being said, partially tax deferred exchanges are valid. That's where an exchanger does receive non-like-kind property of some sort. Most of the time it's cash, so they pull out $100,000 of cash in their exchange. They're going to be taxed on that 100,000, but in their given situation, it still might make sense. They may have owed 300,000 in taxes. Instead, they're just going to pull out 100,000 and pay 30,000 in taxes. So there are situations where a partial exchange makes sense and where it works. So a couple of examples here, just to go through what we just discussed. So you sell a property for $1 million, $300,000 of debt, cost of sale, meaning your broker's fees, your lawyer's fees, your qualified intermediary fees. That brings you to net proceeds of $640,000. So here's a situation where you have a fully deferred exchange. There's no issues whatsoever. Your relinquished property was $1 million, and you bought a replacement property for $1.3 million. So you satisfied rule number one. You had $300,000 of debt. You replaced that with $660,000 of debt. You've satisfied the rule which says you need to replace the debt that you had on the previous property. You have your cost of sale there, which leads to your net proceeds of $640,000. So you reinvested $640,000 of net proceeds, you replaced $660,000 of debt, and you end up purchasing a property for greater than the value of what you sold. You have no boot. $0 in boot means you have absolutely no taxes that are going to be due. So that is a 100% perfect exchange. And now going into an exchange with some boot, and you can see sort of how you end up here. First, right off the bat, you can see this individual sold for $1 million and bought for $800,000. So right there, you see a $200,000 difference. Next, they had a $300,000 loan and they only got a $260,000 loan on the replacement side. On top of that, they had $640,000 of net proceeds, but only reinvested $540,000. So here you can see you have $40,000 from debt of mortgage boot and $100,000, which the exchanger received at closing and took out of the exchange. So that's cash boot for a total of $140,000 in boot. Now, like I said before, there's a chance that this is still perfectly fine. If you are the exchanger who has as an adjusted basis of $0 and your sale of $1 million was all gain, like I said, you're looking at $333,000 in taxes. So if you do this exact exchange and you're left with $140,000 of boot, you have maybe $45,000 due in taxes. So there's still a very large tax benefit, but you have to run these numbers to see if it's going to make sense. I always sort of aim for getting investors to reinvest entirely and getting the full tax deferral. But there are situations where they have to maybe put money somewhere else, or they have to reinvest that money into another property they already own, which is not going to be eligible for 1031. And they need to do some repairs. So they have to take money out of the sale of this one. So there are definitely situations where it happens. This is another conversation I have every day. So I touched on closing costs during that little example. So just to sort of clarify what closing costs can come out of exchange funds and what cannot, there is a revenue ruling and IRS rules that tell you exactly the tax treatment of closing costs. But really what you want to keep in mind is qualified closing costs in a 1031 exchange are the closing costs that would be there if it were an all cash transaction. So if it were an all cash transaction, you would still have your real estate commissions, your title insurance, your closing agent fees. But what you won't have is anything associated with the loan. So buying points for a loan or a lender required appraisal or a lender required inspection, those are not going to be qualified closing costs and they're not going to come out of your exchange funds. So that's where you can create some boot is if you're paying for those types of closing costs out of exchange funds. But any closing cost that would be there in a cash transaction should be a qualified closing cost. Just to we got about 15 minutes. So vacation homes and conversions. I promised we would talk a little bit more about this. So in 2008, when we had the housing crisis, the IRS looked around and said, all of these people are using their vacation homes and 1031ing it. Nobody's paying taxes on their vacation homes. We need to crack down on it. This ended up sort of being a blessing in disguise because they essentially enacted a safe harbor for exchangers and they gave them a blueprint for exactly how to convert vacation homes or personal property into investment property and vice versa, investment property into personal property. So they basically said, if you follow these rules, then we're not going to audit your exchange. If you follow these rules, then you will not owe any taxes. So although they cracked down a little bit, it did at least inform everybody on what the rules were. So how does the taxpayer meet this safe harbor? Um, just to take an example, let's use the moving to Florida, buying your future dream home example. So you sell your investment property in New York, you buy a single family home down in Florida, and the goal is to eventually move into that property. So the taxpayer must own the property as investment property for at least 24 months prior to the exchange. So for 2 years, you have to own the property. During each of those 12-month periods, the taxpayer must rent the property for a minimum of 14 days. So let's say you're Airbnb-ing the property and you Airbnb it for 2 months out of the 12 months of the year. Sounds very simple, but then you really get onto rule three here, and it is not as fair. But the taxpayer's personal use in each of those years cannot exceed the greater of 14 days or 10% of the number of days the property was rented at fair rental rates. So, meaning your personal use is capped at 14 days or 10% of the days you rented it. So, if you rent the property for 300 days in a given year, then you can use the property personally for 30 days. And the reason it brings up fair rental rates is if you rent the property to a related party, the related party must pay fair market value and it must be their primary residence. So this is to stop anybody from just having their kid pay rent every month, but not actually live in the building and only rent it for 14 days. Um, your personal use is going to be heavily capped. And people ask me, well, how is the IRS going to know I use the property more than 14 days? And I always tell them they're probably not. But if you do get audited and the IRS decides to look into your whereabouts in the last 24 months, you're going to probably be found guilty of tax fraud because it is a self-disclosure on the tax forms, which says I did not use the property for more than 14 days. Um, so I always advise against any sort of tax fraud. So that's something to be wary of. But this does give you an exact guideline of how to convert investment property into personal property and vice versa. For personal property into investment property, you just do the exact same thing in reverse, where you have personal property, you rent it out for 2 years, um, hold it out as investment property, rent it for a minimum of 14 days, cap your personal use, and now it becomes eligible to sell as part of a 1031. We particularly see this in places like the Hamptons, where people are staring at $30 million of capital gains and a $10 million tax bill. We say, well, can you wait 2 years to sell your property and rent it out for 2 years? And after 2 years, it'll become eligible for 1031. And now you can sell the property and get the tax deferral because those clients, the $250,000 and the $500,000 exemption are not helping them all that much when you're looking at a $30 million sale. Just something I like to touch on a little bit, although I don't go too deep into these more complicated exchanges in this 1 hour presentation, but I like to bring it up to let you guys know that it is possible and it is available to exchangers. Reverse exchanges and build to suit exchanges. So the two questions that often lead to these conversations are what happens if my relinquished property does not close before I buy my replacement property, or somebody finds a replacement property they really love and they want to buy it, but their property hasn't sold yet. You can do a reverse exchange. where you buy first and then sell later. The biggest hurdle there is ensuring that you have the funds to actually make the purchase because you haven't sold anything yet. So it usually involves a lender, which again creates an added layer of complications. And similarly, you have built to suit exchanges. So you sold for 1 million, and you found a piece of land you really love, but it's only $500,000. So you're not seeing a big tax benefit if you just buy the land. So you buy the land and you improve the land using that fit $500,000 left over of exchange funds, and you can have a fully deferred exchange. Both of these exchanges require a parking structure, which requires the qualified intermediary or IPX to act as the exchange accommodation title holder, which is essentially just an LLC that's holding title to the property while you're either selling your replacement or your relinquished property or while you're building upon your land or whatever property it is you want to use exchange funds to improve. But like I said before, stuff like this, just give me a call if you have a client that's interested or if you're interested in learning more, and we can go a little bit more in depth on it. All right, try and run through this relatively quickly. But the Delaware Statutory Trust. Now, brokers are not always super interested to hear about this, but I like to bring it up because it does provide an option for their clients, and it could potentially help that client who's wary about a 1031 overall, or the seller who doesn't want to sell because they're worried they won't be able to find replacement property. A DST is an institutional quality real estate acquired and managed by a third-party sponsor. Each DST is property type specific, so you generally see them in large multifamily deals, Amazon warehouses, medical buildings. It could be a collection of properties, not just one property. And maybe collectively all of these properties are worth $100 million, but I'm selling my $500,000 single family home that's investment property, and I'm done with real estate. So I invest $500,000 into this DST. Now I own 0.05% share in this DST, and I'm going to receive a return each month, but I don't have to do any sort of management. So it functions very similar to a stock. So registered financial advisors do sell them, and I work with a handful of DST brokers who are all going to be more informative than I am on the actual subject, but it's a completely hands-off investment. There's low minimums. It's very valuable for estate planning because, as I mentioned before, it's very hard to split a property between three heirs. But if you own shares in a Delaware statutory trust, you can pass down shares in that DST to each one of your heirs, and it becomes a much smoother estate planning process. The three situations that I see them the most, and the reason why I bring them up, is as a backup property. So let's go back to the three property rule. You have a property you're under contract for, so you identify that property, and I say, well, why don't you identify one or two DSTs also, just in case something happens. I just got off the phone this morning with a client who's something completely out of his control. The seller backed out. He had only identified that property. He's outside of his 45-day window. So he is looking at a tax bill now. And I'm working on it with him to help him find other strategies. But if he had identified a DST as well, and his property fell through, then he can buy the DST and still receive the tax benefit. And eventually he can 1031 back into real property on the other end of that DST. Additionally, it's used as a boot filler. So you sell for 1 million, you buy for 800,000. Instead of paying taxes on that 200,000, you buy a DST. So you bought one property for 800 and you buy $200,000 worth of a DST. Now you have a fully deferred exchange. You've diversified your portfolio a little bit and you don't have to pay any taxes. So although I always want the brokers to get both sides of the transaction, the sale and the purchase, there are situations where it may make sense to bring up to somebody who's approaching the end of their life and they're looking at estate planning, or somebody who has some of that boot, and you mention DSTs to them, and then they applaud you for knowing that and helping them, and it just leads to more future business. So QI, what is my job? As Jess mentioned at the beginning, I am vice president with IPX 1031, the nation's largest qualified intermediary. My territory is New York. I am based out of Long Island, but I cover the entire state and I do exchanges all over the country. But I particularly market myself within the state of New York. So our main job is that we're holding the exchange proceeds because as we already discussed, the exchanger and their agent cannot touch the exchange funds during the exchange. We prepare all of the legal documentation. So there's an exchange agreement, assignment agreements, exchange closing instructions. And the biggest thing really, although holding the funds is our biggest role, it's really these types of talks, these conversations that I have on a day-to-day basis about what you can and can't do in 1031 because one mistake and your entire exchange could be in jeopardy. And especially when you're dealing with high capital gains, it could be a costly mistake. So although I always tell people I can't give legal advice, I always tell them I am happy to give you guidance throughout the entire exchange process. I do have people who get a little upset with me about the rules, and I tell them I'm not the one who made the rules. I'm just relaying the rules to you. That would be the IRS that you have an issue with, not me. What to look for in a QI? Obviously, me. But safety, security, strength, and expertise. I can't say it enough. FNF, or sorry, IPX is the largest in the country. We do approximately 60% of the exchanges. We are a subsidiary of Fidelity National Financial. So Fidelity Title, Chicago Title, Commonwealth Title are probably our, biggest names in terms of FNF. The QI industry is not very heavily regulated at all on a governmental level, but being that we are a Fortune 500 company and we are a publicly traded company, we are very highly internally regulated. So we are extremely careful about what banks we work with, where we put people's money, and our security controls are very high, and especially compared to other QIs out there. Um, as I mentioned, I'm an attorney as well. All of my colleagues are either attorneys, CPAs, or certified exchange specialists. So there are QIs out there that is one attorney. If something happens, then an exchanger is trying to close on their replacement property and they're nowhere to be found. If something happens to me, there are 5 more attorneys just in the Northeast office that can give you a hand. So IPX, the biggest, the highest security protocols, and we are surrounded by experienced attorneys, CPAs, and even our back end staff as well are all certified exchange specialists. So this is all of my contact information. As I mentioned, I am in New York State, but I live on Long Island. This is my cell number. This is my email. I always answer my phone. If I don't, I will call you back. But thank you all for having me. And the last one here. I put this up because if you could leave me a Google review on my page, it would be greatly appreciated. I don't get paid for these individual talks. Obviously, I'm doing it to get my name out there, to market myself, and to teach everybody here about 1031. I just read an article yesterday that said you can't always Airbnb, or sorry, you can't always 1031 an Airbnb property, it was an extremely misleading and false article, and there's plenty of that out there. So the more reviews I get, the more people come to me and IPX, and the more then I can help people with some of those misconceptions and make sure they're getting the correct information. So thank you to Libor and Jessica and Evan for having me, and I really appreciate talking to all of you today.
Thank you, Ryan. There's just like a couple questions. You did answer the majority, which is amazing. Your presentation was great. I'm just going to ask a couple and let me know if you can answer them quickly, and then we'll do a quick wrap up. So is there anything that we should be aware of in the big, beautiful bill that affects a 1031 exchange?
So the biggest win of the big beautiful bill is that 1031 exchanges were not mentioned at all. So as I said, Tax Cuts and Jobs Act in 2018, that took out personal property. That was about 20% of the exchanges that were going on. So it was always more of a real estate focus anyways, so it wasn't a total death blow, but not being mentioned at all this time around was definitely a win for us.
Okay. Also, does the intermediary also receive the down payment at the time of contract on relinquished
So
property?
there are occasions where we do, if we're involved at that point, but I have people who call me 2 days prior to the actual closing, and they bring up the down payment, and there's always two things. If you want to be on the safest side of things, then your attorney or whoever's holding the down payment at that time at closing should wire the down payment to the exchange account along with the rest of the funds that are received at closing. But most of the time, the down payment can just be put towards those qualified closing costs that I mentioned. So if all of your down payment is just going to go towards realtor fees and legal fees and other qualified closing costs, then you don't have to worry about wiring it to the exchange account. But I always tell people at closing, wire it to the exchange account just to make sure you don't run into any sort of issues with boot. But on the replacement side, there are two instances where us as QI is allowed to wire out, and that is for the down payment and the closing. So if you find your replacement property and you need to send a down payment out, we can wire that money out of your exchange account at that time.
Okay, fabulous. I'm going to just have two more questions here. To identify a property, does it require filing paperwork or a simple email would be sufficient?
So not an email just because you have to sign
Mhm.
it, but it's just an adequate legal description of the property, which is normally just the address, and your signature to a qualified party. It's usually to the qualified intermediary. We have a form that we send to people via DocuSign. So you just fill it out, you put the address to the property, you DocuSign it, and you send it back to us. And that's all you really need. Any QI out there, once you close on the property that you're selling, is going to send you a similar form. But there's not one that you need to file with the IRS. It's usually to your qualified intermediary, but you can write it on a napkin and sign it really if you wanted to. We don't advise it, but you could.
Okay, last but not least, and any other questions that haven't been answered, Ryan's information has been put into the chat. So a nonprofit organization purchased under an LLC, buying a new property, selling an old one, will they be able to do a 1031?
So it would depend on the type of LLC. So if the nonprofit if the nonprofit was the sole member of the LLC that owns the property, then the nonprofit could buy the replacement property under the nonprofit, or they could form another LLC, which the nonprofit is the sole member of that LLC and buy the property. Regardless, the entity is allowed to do an exchange, but I would just need to know a little bit more about the structure of the LLC to figure out exactly how they need to get it done.
Okay, perfect. Again, everybody, you can reach out to Ryan. His information is the in the chat. But again, you had such an insightful presentation, and thanks to everyone who joined us today. I hope you're leaving with a lot of good takeaways that you can actually use right away. And before we go, we just want to do a quick highlight for our commercial month. So our next program, and this is a big one, is the Certified Commercial Investment Member or CCIM designation, which is commercials real estate's global standard for professional achievement earned through a very extensive curriculum. So on October 16th, we're actually going to offer one of those courses needed for that CCIM, and it's going to be called the Introduction to Commercial Real Estate. We're going to be hosting it at our new LIBOR Melville headquarters. Okay. There's going to be a follow-up email that goes to everybody in this webinar. So that will be listed there. You should definitely sign up. It is going to be a great asset to your designation. We're also hosting the CRE Connect October 27th. It's going to be featuring Joseph James. He's presenting Leveraging AI for Commercial Real Estate Marketing. It's a 2-hour session with CE credit pending, followed by some networking at the New Hyde Park Inn. So everybody, we appreciate you being part of the commercial network. Have a great afternoon. And we'll see you at the CCIM course, hopefully on October 16th. Thank you, Ryan.
Thanks, guys.